We also got little Piper shaving price targets, but day in and day out, at 170, have we seen the last of these, or close to it, David?
Well, I hope so. It's one of our largest positions, but think of where we were just a couple of months ago and the narrative change. Stocks at 230, we're talking about, well, maybe it deserves a consumer staple multiple. Now here at 170, 12.5 times next year's earnings, 10.5x cash. It's like dead hardware company walking multiple now. We think it's overdone.
Larry, you agree?
I would certainly concur. Every morning, Carl, Apple's installed base of customers increases. And there's basically no way that this doesn't happen. And each year, these customers spend more money on stuff. And basically, Apple has a monopoly on the services and accessories business. You really are very hard pressed to buy things that plug into your Apple devices anywhere else. And the margin on these things and the margin on the App Store are very, very large. And you look at Apple, I think, on it's not only the valuations, it's the free cash flow characteristics of the earnings. Apple does not need capital to grow. They don't invest in hard plant. They sell stuff that, generally speaking, declines in price or stays flat. So there's no current asset requirements. They don't finance receivables.
Right.
And it's just a cash machine.
And yet, David, we do see this period of investment happening right now for the biggest tech companies. Apple is building out in Austin, Southern California, Seattle, a few other places. Amazon, we just heard about their new branch announcements. Google's trying to expand in San Jose and some other places. Are we going through a period where some of these companies, in order to fuel their next leg of growth, feel the need to lay the groundwork in the form of investments in people and plant? And should investors read anything into that?
Yeah, absolutely. Again, the companies need to reinvest. These are asset-light businesses, and at the margin, it's people. And when you mentioned all those geographies, they're spreading the wealth, so to speak, across the country. I think the Apple announcement today, I'm sure there's some folks in D.C. that are interested in that announcement as well. I mean, there's even with Alphabet, geopolitical news in the sense of regulators looking at them. So again, to your point of your question, certainly there's going to be people growth, and we would hope to see that. I mean, the companies might not need to invest in significant plant and equipment, but for that next greatest service, you need the people to do that.
Larry, given all the headlines and maybe potential cautious optimism around a deal between the U.S. and China, how does this play out for Apple?
Well, I think the stock, in order to really perform well, Morgan, has to solve the China problem, or somebody has to solve the China problem. And I think the president, he gets sport out of negotiating. And all of these negotiations, you watch Washington over a period of 20, 30 years, they always go down to the last minute. So we're not going to know really until the end of March whether there's a deal done. There'll inevitably be a deal done, whether it's significant or not. You know, who is to know? It's the fine print, the legalese. But the Chinese government isn't in a particularly good position right now. Things are clearly slowing in China. The currency is at the upper end of what I think is socially acceptable. The Chinese government basically has to maintain stability. If they don't maintain stability, there's a chance that people, may protest, as they did in Hong Kong 5-10 years ago. So everybody's interest is in solving this problem, and I just think it's going to take a while, and it's kind of sport for the powers that be. I think they've already taken the toll on the shareholders. This stock's down $70 billion. That's enough penalty for one perhaps delay in some cash flow.
David, I wonder how you think more broadly, Apple, FANG, old school tech, however you want to frame it, will play as a narrative in 2019. Is it going to get as much attention as it got this year?
I think it will, but for maybe different reasons. Maybe the sexiness is off of it. I mean, Apple, Qualcomm, they're off 30% from recent highs. Facebook, it's off 42%, peak to trough. That said, if a stock is going to outperform, if they're among the leaders, they're going to get the attention. And certainly given we're invested in those names, we're expecting that next year. So it may be a little bit of a different thought. in terms of how dominant anything and everything about FANG. One by one, they've been taken out and shot, and for usually company-specific reasons, but the valuations are such that we like them here. We like them a lot.
Larry, you also are invested in some of the media companies. You follow some of the more traditional media companies. Earlier this week, we had that multi-billion-dollar non-cash charge with Verizon. Obviously, AT&T and Time Warner continues to be in focus. How are you thinking about these stocks?
Well, I think what's happened here, Morgan, is that the market is assessing a penalty on deals. Deals are terrific. They generate fees for the investment bankers. You get a lot of enthusiasm on the sell side of the street. The reality is most deals really don't work tremendously well. And we've got two poster child deals here that aren't really working as far as I could see at all. I'd give them at best a C-.
Which
That's
ones?
AT&T, Time Warner, and Verizon with Yahoo and AOL. And you've just basically had the Verizon board say we've made a $4.5 billion mistake. And people look at this and they say, well, it's not cash. Let's just ignore it. Well, it is inevitably cash because there's a lot of management time, and the shareholders of Yahoo, which I was one, got something in their pocket for the trouble. And now the shareholders of Verizon are getting really nothing. The shareholders of AT&T right now, for owning Time Warner, are having to worry about the dividend. And you look at the cash flow of AT&T, and you look at their interest expense, and you look at the dividend, and there's really very little money to reinvest in growth. So it looks like to me AT&T's painted itself into a corner. So the mergers, I think, for 2019, they're going to be less deals. Especially if rates go up, and I think rates are probably going to go up a little bit.
Like the anti-Gabelli argument, Larry.
Well, you know, I'm an alumni.
I know.
It's a little bit of an ancillary area to where you normally focus, but it's interesting. You talked about all the FANGs being taken out and shot. Google and Facebook have been dominating the digital media and advertising story, and yet all of these upstarts, Oath, the smaller companies, a lot of them are around New York, are struggling now because of the dominance of Facebook and Google. So has everybody just overestimated this category in general, including the potential for Facebook and Google, or what?
Maybe they have. I mean, these are such dominant media companies, Facebook and Google. I mean, you think about what it would take to displace them, particularly on the ad spending. There's going to be startups, there's going to be a lot of effort, there's going to be Silicon Valley funding to try to maybe pick out some niche areas. But at the end of the day, these companies still dominate that ad space and their market shares within that space.